Hey, everybody. This is Paul Moore with Wellings Capital. I'm joined by Ben Kahle and Warren Taryle, and we're really excited to talk with you today about a creative strategy to offset capital gains using commercial real estate. There's some people still coming in, so we'll wait just a minute and then we'll get started.
I do just want to let everyone know that we will be doing a live Q&A at the end of this presentation. The presentation will be maybe 25 or 30 minutes. And please, if you have a specific situation you want Warren and Paul to speak to, you can ask that in the question box. And we will get to as many as we can before the end of the webinar. So we won't be answering any questions until the second part, probably about 25 to 30 minutes.
All right, great. So, like I said, this is a creative strategy to offset capital gains and other taxes using commercial real estate. The disclaimer is I'm not a tax professional, and for you who were around in the 70s, you'll know what I'm going to say next, and I don't even play one on TV. But the good news is my friend and tax strategist Warren Taryle is here with us, and he doesn't even play one on TV. He is a CPA tax strategist. He has worked with some of the top real estate investors in the world, and so we're very happy to have him here with us. He is a real estate investor himself. He's an expert. He's got a master's in taxation. He's focused on helping people reduce their taxes. And I can tell you that I had a tax problem recently. And I went to Warren and I said, hey, I've talked to several people, CPAs, non-CPAs, nobody has an answer for this. And I said, can you help me? And he helped me, and I am, as a result, saving a ton of money on a transaction, an investment that I'm making and selling actually in November. So I'm really excited to have him on board with us. I'm Paul Moore. A lot of you know who I am. And so we're really, really glad to have you here with us, and excited to get to the questions in a while. So today's discussion, some of you read my email this week, but some of you getting the recording won't have read it. I have a friend named Jay, we'll call him that, and he is in Roanoke, Virginia, and I was always a little suspicious of his crypto mining profit thing he and his son were up to, but they had been at it for a long time and they made a lot of money. And I heard about it a little bit too late, and he was telling me he had hundreds of thousands of dollars in a tax bill, and it was after the first of the year. I couldn't help him. That was selling crypto stocks. I talked to another investor yesterday, was selling other stocks. He had a gain. And if he acts before the end of the year, this strategy we're talking about could help him. I've been for years telling people about Bill. We'll call him Bill. He's in Virginia. He sold a furniture store, and he had an $800,000 sale of the physical real estate. And he was in the middle of a 1031 exchange. He tried as hard as he could, and he couldn't find anything that made sense to exchange into. He eventually punted on that exchange, and it was awfully painful. So today we're going to go over an example like that, similar to Bill's, and then we're going to go over an alternative narrative of what could be using this tax strategy. We're going to talk about a few other things. Who's this for? How does it work, and why does it work so well? Could this work for you? When does this strategy fail, and what are the alternatives? We don't want anybody to leave this webinar thinking it'll work for them and it won't, and Warren's going to check it. He's going to get into all that, and then we're going to get into the Q&A. So it's widely known that a 1031 exchange and other tax strategies can help grow your base. I've been saying for years that true wealth is assets that produce income, and you can grow your asset base much more if you don't tax it along the way, and you can produce a lot more income along the way. The problem is a lot of people don't get good tax advice along the way. And by the way, this chart here is about 1031s, but what we're talking about today is a way to do it without the 1031 exchange. But in your Q&A, we can get into that, into the 1031 as well. So this person just happens to have an $800,000 real estate asset sale, and he has got a potential tax. Let's start with long-term capital gain. 20% long-term gain on $400,000 profit. In other words, half of it was gain. And so he might have a 20% long-term gain of $80,000. And then on top of that, this asset produced a lot of cash over the years, 500,000 in this example. And at the top marginal federal tax rate of 37%, that would be a depreciation recapture on those past taxes that weren't paid of $185,000 in potential liability now. For this example, we're going to assume there's zero state capital gains tax because all states are different. The net reinvestment in this case then is $800,000 minus $80,000 in long-term gain, minus $185,000 in depreciation recapture. So they're going to net $535,000. They've lost a third of their principal. And let's be honest, a lot of us would accept that. A lot of us would expect, well, that's just how it is. But real estate is different. Real estate provides opportunities to shield your taxes, your capital gains and income taxes in ways that a lot of other assets don't. So here's the alternative narrative. So reinvesting the $800,000 into a highly depreciating real estate asset, assuming 100% bonus depreciation in the same year. Now, you might say, wait a minute, how am I going to get 100% bonus depreciation? Well, some assets like mobile home parks and modular self-storage, like think about pods or something like that, or a self-storage facility that's built based on modular construction can be highly depreciable in the first 15 years. Well, Warren's going to get into why that could be so powerful for you, but I'll just tell you the bonus depreciation on something like that could be all compressed into year one instead of spread out over 15, 27, 39 years. So the potential tax shield on this would be, for example, 37% on $800,000. That's $296,000 of potential tax shield. At least that's how I call it, what I call it. 37% depreciation recapture. Remember from our previous slide, that's 185,000 shielded, and this has 111,000 to go. State capital gains, we're assuming zero. Capital gain, the long-term capital gain of 80,000 would also be shielded. And so all of this would be shielded, and the net reinvestment would be $800,000. There'd be no tax paid in that year. And there's actually other benefits. If you stick around, Warren's going to tell you other potential taxes that are shielded as well. So why is this important? Well, the problem is created by selling an appreciating asset. So what's an appreciating asset? Well, it doesn't have to be real estate. It could be stocks and bonds, it could be cryptocurrency, like I mentioned. It could be other types of assets, like gold, silver, etc. It could be real estate through a direct acquisition and ownership. It could be through a syndication, could be through a fund. A lot of people have been saying you can't get many tax benefits coming out of a syndication or a real estate fund, but that's not true. You can. Another thing is people think you can flip a house and do a 1031 exchange. If your intent was just to buy it to flip and not hold for investment purposes, then you can't. You can't do a 1031 exchange with that. And so somebody with a large profit from a flip house would be faced with all those taxes I mentioned earlier, maybe more. An abandoned 1031 exchange would be another person that might be interested in this, somebody who missed their 45-day window or just couldn't find an asset to exchange into. So I'm going to let Warren take over. We're going to talk, again, this is Warren Tarle. I'm going to open up this whole slide so he can take a look at it and speak to why this works, how it works, and why this could maybe work for you. Warren, thanks for joining us.
Great. Thanks for having me here. I know we talked about this the other day. You got a little, it's fair to say, a little excited.
Yeah.
So first of all, I want to say that we can talk about it offsetting the capital gains, but what the important thing is, right, when you have that gain, whether regardless of where it comes from, it comes to your personal tax return. So it's on there. So if we can create a loss somewhere else, it doesn't necessarily have to be directly related to that gain you're receiving, right? So long as we have a negative on your tax return and it all nets out as if that gain wasn't there, in your example you just gave, it actually turns out better than that, right? Because there's a bigger write-off than there are. We shielded the two types of income and there was still something left over. So in my way of thinking, we're actually also shielding maybe some of your W-2 or business income. So it works out really well. So what we have to first do is get out of the paradigm where we're thinking that it has to fit that exact type of thing. So if I have a capital gain, I need some kind of capital loss or way to offset that gain. Well, no, it doesn't have to be in that hole. It could be anywhere on your return. Uh, and so what we're talking about here is being able to use the accelerated depreciation. It became part of the law in 2017, really became effective 2018 tax returns. And let's back up and talk about bonus depreciation really quick. I know people on your call, people that follow you, know this stuff really well. I'm really impressed by the knowledge that they have, but let's pretend like they don't know, and I'm going to tell you anyways because I have to have something to talk about. So bonus depreciation. First of all, when we have and we'll put it in terms of real estate, when you buy some kind of a building, some kind of property, if it's commercial, we depreciate that over 39 years. So we take whatever the purchase price is. Sometimes we have to break out something for land, take the remainder, basically divide it by 39. And that's how much you get to depreciate every 12-month period. And that's the rule for real property, the real estate, right? The building. But when you buy that building, you buy more than just real property. You also buy a lot of personal property. And personal property can be depreciated over 5 or 7 years, depending on what it is. And so we get that faster depreciation. And this isn't new for the 2017 law. This has been around for years and years and years. So we get 5 or 7 year property. Plus, there's also sometimes things on the outside, things we've done to the land, which are called land improvements. So it's like driveways and fences and walls and everything you do to the land is a land improvement. And that's 15-year property. So now, if you buy a commercial property, it's really a basket of 5-year property, 7-year property, 15-year property, and 39-year property. So just doing that, having somebody come in and tell us with a cost segregation study, tell us out of my purchase price, how does that purchase price fit into those various buckets? So they'll give us that report and put it into all those various buckets. What became new in 2017 law is that everything from 15 years and shorter, we can now choose to write it off 100% in the year we purchased it. So no longer do we have to spread it out over 5, 7, or 15 years. We get it in year 1. So that's huge, right?
Mm.
Now let's put this in terms of a self-storage facility. And you mentioned, say, let's do a modular self-storage facility. The modular self-storage, those modular units are not attached to the ground, right? And our cost seg study people tell us that those modular units are really considered personal property and we can get 7-year depreciation on them. Okay, that means they fall into the bonus depreciation category where we can write it all off, right? Because less than 15 years. What else do we buy when we buy a self-storage facility? Well, we got the storage units. We know we can write those off. What else is there? Well, there's driveways and walls and fences, and oh, those are all land improvements, remember? So we get a big chunk of it that's going to be land improvements as well. That's 15-year property. Pretty much the only things we're not going to be able to write off 100% in the first years. Well, if there's actually a structure on that property, maybe there's an office building, a real physical building, and so that might be stuck with 39 years, and they'll give us the evaluation on that. And there's, remember, something for the land that's there, so there might be a little bit we can't depreciate because of the land. But otherwise, we're looking at, and I know you used 100% because what it does is it helps us with this example. Instead of having to do math, we all get the concept of, all right, I can put the $800,000 and poof, this is what I get to depreciate.
And I'm going to jump in, and I should have said this earlier. Sorry for interrupting. The reason it works in part is leverage, because if you're putting 800,000 in and you're matching 800,000 in equity with, let's say, 1.2 million in debt, you're buying a $2 million property. Well, if that $2 million property is 50% depreciable in year one, that's $1 million in year one. You only put in 800,000 in equity. That's why that works so well, just to be clear.
And it's, yeah, and it's kind of mind-boggling when you think about it that way, right? You're out of pocket $800,000 into the property, and you're already getting maybe $1 million, maybe even more of depreciation right off the bat. It's
right.
It's such a positive development that came out of that 2017 tax code. So that's the idea, right? And the same thing works, as you said, for mobile home parks too, because there's, especially if you're getting a lot of the mobile homes as part of it, that's going to be part of the rental. So it works very, very well for those kinds of things to give us a giant deduction right off the bat.
Yeah. It's really powerful. And again, it wouldn't work without, I mean, when you think about taking land out of it, that might be 20 or 30%, and it wouldn't work without the leverage. But fortunately, a lot of things are leveraged, and so that's why you get the 100% in some cases. Of course,
Right.
this
And
is
even
only
with the land in there, right? Even without the leverage, there's the leverage between tax brackets too that help
right.
us.
Yeah, tell us about that.
So remember back in the example, we had $400,000 of the gain was taxed at the 20% long-term capital gains tax rate, right?
Mm-hmm.
So that's what you're paying tax on, right? We're calculating the tax on that 20%. But when we get this deduction, we're getting this deduction at ordinary tax rates. So that means the deduction is going to be used at 37%. So the minus numbers times a higher percentage than the plus number. So there's
Amazing.
just that difference in there, the arbitrage, if you would, between tax rates that even push this even further over.
Mm-hmm. Right.
And let's think of this as, now let's say you're not selling a rental property. Let's say it is stocks or another capital asset that you haven't been depreciating. So now that whole gain is 20% gain, right? We don't have any recapture numbers to worry about. So we even get a bigger arbitrage there when we're looking at stocks or cryptos or whatever other capital asset you're selling that maybe was never depreciated.
Right. Yeah, it's very powerful. So you're going from a straight 20% capital gain only to a 37% write-off, right?
Right.
Or at least 37 in this investor's case.
Right. And yeah, in our example here.
Yeah.
But as your personal tax bracket goes down, so does the capital gains rate. So it kind of fits.
Right. So Warren, who's this for? I mean, who would this work for? And then our next slide will be, who is it not work for?
Well, and I'm not sure, I might blur between these two slides, but that's all right.
That's fine.
this is for people. So if somebody is a qualified real estate professional, it's a no-brainer. This is the
Right.
easiest thing there. This is as easy as sliced bread, right? We'll be able to take care of those the fact that it's a passive loss. But some people are going to come back and say, but Warren, I'm not a real estate professional. How do I deduct these passive losses? Well,
And real quick, sorry to interrupt you. What's a qualified real estate professional for those who don't know? What is the definition?
uh, a qualified real estate professional, good question. So under the tax rules, there's certain exceptions that will allow us to deduct passive losses. So normally under the normal rules, we have three buckets of income. We have earned income over here, we've got passive income over here, and we have some weird thing called portfolio income in the middle that we'll forget about for now. But under the tax rules, you can't move a loss from one bucket to another. So if we have passive losses under the general rule, I'm not allowed to use those passive losses against earned income, for example, like my W-2. It has to stay in that passive bucket. So if I have a rental property, for example, that loses money, I need another rental property or some other kind of passive investment, something that I'm not actively involved in. I'm spending very little time, if any time, and it's all my money's in it. That's what's making the money for me. I need to I need to have that income, and to the extent that I have passive income, I can net those together. And if my passive losses are greater than my passive income, that's what's called a suspended loss. I don't get to deduct that. I could get
Okay.
passive to zero, and then the rest rolls forward. If I can qualify as a real estate professional, it's an exception to that rule, and it says now I can deduct those losses regardless of anything else. And to be a real estate professional, it's a time test that says you spend a minimum of 750 hours on real estate related activities. That's the easy part. The harder part says you also have to spend more time on real estate related activities than any other income producing activity. So that's the 10,000-foot level of real estate
Yeah,
professional.
it's more time than any other activity, or is it more income than any other?
More
It's the
time,
time, right?
more
Okay.
more time, because if you think about it,
Yeah,
what we're trying to do is deduct a loss from real estate. So
of course. Yeah, I think a
So
lot
real
of people get
quick,
confused on that point.
yeah, so Warren, let's just use a crazy example. Let's say I made $100,000 from YouTube income. Let's say I got popular on YouTube, but my primary job is what it is now, which is working for Wellings Capital. Um, because I'm a QREP, I can use my real estate losses to wipe out the gains from that kind of that self-employed income from YouTube. Is that right?
exactly.
Okay. But if I'm not a QREP, but I do have real estate losses, let's say for my own personal portfolio, I can't wipe out my YouTube income.
Correct. And
Okay.
those losses roll forward to the next year. And we see if you have any
Yeah.
passive income that year. If you don't, it rolls forward. And this is really important because this will fit back into our example here in a second. Those passive losses, those suspended losses roll forward indefinitely until you either have some other passive income to use them up, or you sell whatever property you had that created those losses in the first place. And the year you sell it, those losses free up. If you do a 1031 exchange, that is not considered a sale. So those losses just roll into the next property that you're going to buy.
Right. So basically, what I'm hearing is passive, if you're not a QRP, gains passive gains can only be wiped out by passive losses. But
Right,
if I am a QRP, my active gains can be wiped out by passive losses regardless of the asset class.
right. So
What
that's
if
what
my
I'm saying.
spouse is a QREP, real quick?
Yeah, then you're good. So if you file a joint return, just one of the people on the return needs to be a real estate professional.
Okay.
So now back to our example where we were. So if you're a real estate professional, this works beautifully, right? Because the investment might be a passive investment. Like if you're going to go in through like a DST or somebody else's another program, maybe it'll generate these passive losses for you. No questions. It could be a mobile home park, it could be whatever, any of these things. If you're the real estate professional, we're good. But let's say you're not a real estate professional. What can we do for you? There's a couple of options here, and it first depends upon what created the gain. So if we're selling a passive activity, so in our example, we're selling a rental property, and we had $400,000 of gain plus the recapture, we have all that gain that we made for, and this is a really weird quirk of the law, but for passive loss purposes only, that gain is considered passive income and will free up an equal portion of passive losses. So I know you're looking at me like I have a third eye, but so in the example, let's just pretend like it's only $400,000. I know there's some more for the recapture, but let's say it's $400,000. We will now be able to free up $400,000 of passive losses that are hanging around someplace, because that's considered passive income. We still get capital gains tax rate treatment, but it's also considered passive income because it was generated from selling a passive activity. So what does that all mean? Blah, 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 Warren. What it means is this: if you go into one of these investments and we get the big loss and you're passive, well, guess what? I just created $400,000 of passive income because I sold that property for $400,000 gain. That means I free up $400,000 of passive losses. So long as we're doing it in the same calendar year, they will net each other out.
Okay.
Wow.
So there's probably people on here live and who will listen to the recording that are saying, okay, maybe I can apply these laws to my situation. If you're wondering that and you're live, begin to formulate a question, and we'll try to answer. And if you're not listening to this live, you're listening to the recording, send us an email or send Warren an email, and we can talk it through, because there's going to be so many different situations. There's going to be so many variances. We're not going to be able to cover all of those on this fairly short call right now.
And I'll do this really, really quick, I promise. But so the other scenario is, what if, so what I told you was if you sold a passive activity, right? So that frees it up. But what if now we're back to talking about stocks? Those aren't passive, right? They fit that weird middle category called portfolio. So what if you're selling stocks or crypto or whatever that generated that gain? Now all of a sudden I didn't create that passive income, and I'm still not a real estate professional. Let's say, well, if we're going into the mini storage situation, if I buy that outright myself and I run that as a business, so it's not real estate, it's not rental income anymore, right? That's one of those weird things, right? Is this an operating business or is this rental real estate? I think we get a little bit of say in how we want to do that and how we structure it. So we could come back in and say, no, this is my new operating business I'm going to have. And it's a whole different threshold of requirements. It's a much easier threshold to fill and say that I'm materially participating, therefore being able to deduct those losses. It's much easier than qualifying as a real estate professional. So there's still that option where I can come in by my own property, operated. I can be the operator, my wife could be an operator. They come in, run the thing for the rest of the year, qualify as materially participating. It's not a passive loss anymore. It's an ordinary loss, so we get it deducted against the income anyway. So we can, there's a way to make this work for a lot of circumstances.
Yeah, and that's the alternatives for active investors at the bottom, right, Warren?
Yes.
So before we go on, what's the missed calendar year and the reverse thing?
So we really want to do this all within the same calendar year. So we net this whole thing out, we free up the passive losses, all of these things work out that way. But let's say somehow we're able to buy the storage facility first and then we sell it in the next year. We can still it'll still work for virtually all the cases because that loss will just roll into the next year. So we got to get the loss first and then that'll roll into the next year. What we can't do is have the gain this year and get the loss next year because the loss won't go backwards.
Okay. So there is an argument for somebody who might be able to take the loss now and then sell the stock or the asset next year.
Right.
All right.
There is a little bit. I'll just be honest. There's a little bit of risk in doing the that way. Just a legislative risk, right? We don't know if in the next year they decide to change all the rules on us. But
okay. I can't imagine that happening. I'm being sarcastic. I shouldn't do that. Okay. So Ben, where do we go?
Yeah. So I want to throw out a question received prior, and I want to make sure we're honing in on some exact situations to try to make this as plain as possible. And first, I want to back up as to even why we're doing this webinar. What led us to get here is Paul and I did a call with a cost segregation person in the company. Her name's Kim Lockridge of Engineered Tax Services, and she's doing the cost segregation study for the DST property, which is a storage facility in Texas. And we were trying to get to the bottom of, okay, what's the depreciation on that property? And we came to the conclusion it's about 100% depreciation in year one. So if you invest in 2020, 100% of your invested amount plus or minus can be would be an NOL, a loss. And we were thinking to ourselves, okay, yes, the DST is amazing for 1031 exchange investors, but we didn't want to make this just a pitch for our DST. We really wanted to try to bring good information that's hopefully helpful to everyone listening. But our DST would be a really good option for people who might not be selling a property in a 1031, but just have some sort of gain from stocks, from other real estate that they didn't do a 1031, from other types of assets in 2020. And they're coming to the end of the year and they're saying, I have a tax problem. Like I need to get a lot of depreciation. So we were saying, wow, we need to make people aware of how good of a situation this is. So that's just to add a little more context and color. But one of our investors who we've become good friends with sold a couple rental houses and thought that he could start the 1031 process after selling them. So what you're supposed to do with the 1031 is contact a qualified intermediary, and the proceeds from the sale has to go to the qualified intermediary. It's a legal process. So he was like, oh my gosh, I missed it. I missed my 1031 opportunity. Warren, is it true that he could have almost, it's not a 1031, but he could, depending on his situation, but he could wipe out his gains from those rental properties by investing in our DST, assuming 100%.
Oh, sure. Just if it has to fit the circumstances, but yeah, it's definitely possible, and it's actually possible that he comes out further ahead than if he did the 1031 exchange. So not doing a 1031 exchange in a lot of cases is much smarter than doing the 1031 exchange, because remember in our conversation just earlier, and I said that if you have passive losses that are suspended and you do a 1031 exchange, those passive losses stay suspended and they roll into the next project that you're in and wait for you to sell that one. But in this case, if his 1031 exchange failed, And let's say he did have suspended losses, those suspended losses free up right now, so he gets a deduction for those. And remember, again, our arbitrage between tax rates, he's paying capital gains at 20%. He's getting, in our example, again, he's at the 37% tax bracket, so he's getting those losses freed up at 37%. So he's coming out ahead. And now we're going to go into this property and we're going to wipe out that capital gain anyway. So
Right. Okay.
yeah, 1031 exchange, don't always assume that the 1031 exchange is the best thing for you. Get an accountant to at least just run through the numbers. It takes just a few moments. It's really an easy calculation just to see if a 1031 exchange even makes sense.
Okay. What if one of our investors invested 100 grand maybe 3 years ago in a multifamily syndication, and they got some great write-offs. The property sells in 2020, so they have a gain plus some depreciation recapture they're going to have to pay. By investing in our DST, depending on the situation, but in theory, they could invest in the DST and eliminate that depreciation recapture and the capital gains.
Yeah, absolutely. Again, it's the same
Okay.
examples. It works
Okay.
exactly the same as selling your own property. Uh,
Okay.
and they couldn't even do a 1031 exchange if they wanted to, because they're coming out of a syndication unless every person in the syndication goes into the new property together.
Okay. Got it. All right. So I'm going to get to Roger's question. What if I have a primary residence with potential gain greater than the marital exclusion? Can I rent it for a year, then sell with the intent of engaging in a 1031 for the portion of the gain amount in excess of the marital exclusion, thus exchange a portion of the sale and lift out the exclusion gain? Doable?
So you want to do you can do it in that order. You have to be very, very careful of the time periods, because they'll look back to get the $500,000 exclusion. But again, let's look at the situation. Is it really worth that? Is the gain that much more? Which it could be. Uh, but yeah, you could do the 1031 exchange. You just have to be really, really concerned about the holding period, like how long it was a rental.
Okay.
Timing is very sophisticated. Or you can do what we're talking about now and not worry about the 1031 exchange. Take the exclusion, take the rest of the money, put it into a new project like we're talking about here, and take the loss.
Okay. What are the tax implications for the annual distributions of the DST, Wellings Capital DST, and at the end of the DST? So I can speak to that a little bit. I think, Paul, you might have more to add, but
Okay.
I think so. For the annual distributions are projected at 6% a year,
Right.
at least for the first 5 years, I would say. And depending on how you work out your tax situation, I would expect those to be uh, the distributions to be wiped out by the losses on the property.
Unless they were gobbled up year one from a previous gain.
Right. Yeah. And then at the end, in a perfect world for real estate in 10 years, we would know where the tax laws and the 1031 exchange laws are going to be. If they are as they are now, which who knows, you could do another 1031 out of the DST into another property, or you could invest in another depreciable property and wipe out your gains. Is that correct?
Right. Or there, and you could, I don't want to say it this way, you could pass away and it becomes part of your estate and you get a step up in basis, so your heirs don't have a gain.
Okay.
The final exit strategy.
Just
Yeah.
don't tell your heirs along the way.
Yeah. It might hurry the situation up.
Uh-huh. So I think one point of confusion or a question that might be in people's minds is um, like that whole active versus passive discussion. And Paul, maybe we could speak briefly to that situation with one of our investors who was a early employee at a tech company
Mhm.
that I believe went public
Mhm.
and has quite a bit of stock
Mhm.
and trying to sell that stock. Could he do this?
The reason he probably could not do this, and I'll let Warren speak to this more, is that because he was an insider at the company, Warren can, tell me the right term. He had an active gain when he sold his stock. It wasn't a portfolio or a passive gain. And so I think he's sort of stuck with getting an active replacement. Is that right, Warren?
Right. So he fits into that second scenario that we talked about, where he he didn't sell a passive activity. He sold a stock, and because he stole a stock, he doesn't have any passive income to use to free that up. So he would have to be the one who goes into a property that he or his wife is going to manage and run as their own property, so that they become materially participating in that.
Right.
But okay, let's say an investor has been investing in Amazon stock for the past 15 years and they have $3 million of gains that they're saying, I want to cash out 1.5 million at this point, or I want to, sell it. Is that considered passive? They're not employed at Amazon.
No, because it's a stock. So the
Okay.
employment part actually doesn't matter. It's because it's a stock, uh, and stocks are not considered passive. I mean, to us in the wealth building world, are considered passive, right? We're not working in the company. But the tax code, I said there's three buckets. There's the earned income bucket, which is when you trade your time or knowledge for money. So it's your job or a business that you actively participate. The other end of the spectrum is passive, where your money works for you. And rental real estate is passive by definition, or if you're a silent partner in someone else's business, those are all passive sources of income. The middle one is called portfolio income, and that's generally from paper assets. So it's stocks and bonds. So the type of income is going to be capital gains, interest, dividends. Those things fit into that middle bucket. And we created all those back when we had tax simplification the last time during Reagan. And we used to have one kind of income, and this was all really easy. Then we simplified it into three kinds of income. And my only thought is we have three because three seems more simple than two. I don't know.
Okay. Okay. Someone said, can it offset W-2 income, or is it only capital gains if we don't qualify for QREP this year?
So again, the same situation with the Amazon stock. It can certainly offset W-2 income. In the first example that Paul gave us right in the beginning of this webinar, we actually had more loss than we had of those gains, and that additional loss in that example would go to any other kind of income, W-2 income, business income, it would go there. So certainly we can offset the W-2 income. We just have to be actively participating in that new project that we buy.
Okay. Is there anything someone with a large stock sale can do in that year to reduce their tax bill?
Well,
Or are they kind
aside
of
from what we
stuck?
just talked about,
Are they like becoming an active owner and buying a property and all that kind
right,
of stuff? Is
right.
that is that pretty much the only route?
Well, I mean, in what we're talking about, there's harvesting some losses, see if they have losses someplace else. A lot of times people have promissory notes out there that they're having trouble collecting, and maybe they accelerate that and write it off that year and offset it. Maybe you have some losing positions someplace else, you want to sell them, wait 30 days before you buy them back, and generate some losses. And then there's, always the opportunity fund zone things that, it's a
Mhm.
little bit of a religious war. Some people love them, some people hate them. I'm agnostic, so.
Mm.
Okay.
All right.
And that would be QOZs, qualified opportunity
Right.
zones. Okay. Okay.
I threw a few in here that I've gotten recently from people outside this webinar. So do all DSTs work this way? And what about funds? And what about individual syndications? Do they all shield taxes in the same way? And I'll start by saying, since I put the question in, that no, the DST wouldn't work the same way if there wasn't a massive bonus depreciation opportunity in year one. However, if there is, I think that it could be a DST, an individual syndication, or a fund that would shield taxes. It's the bonus depreciation and the passive losses that are generated that make this work. Isn't that right, Warren?
Exactly. The thing that the DST adds is if you want it, if you're coming from a 1031 exchange, you can exchange into a DST. All those other options are much more difficult if possible at all.
Yeah, right. And so someone asked me yesterday, what's this tick thing, tenant in common? Why does that work? Like, why would that work for the guy earlier? What is a tenant in common? Warren, you want to jump into that?
It's a form of it's a form of ownership of a property. It's very similar to the DST, and it was in vogue before the DSTs were invented because you could 1031 exchange into a tick. It's just that the management is very unruly in a tick, and it caused a lot of problems and even possibly litigation down the road because there was too many hands in the management of what was happening. So that's where DSTs kind of somebody invented basically a DST to have all the good sides of a tick and try to avoid that negative management piece.
Mm-hmm. Okay.
I think,
So
go ahead, Paul.
I was just going to say, I just wanted to add to that. So a lot of operators really don't want to do a tenant in common. I mean, you might be able to find an operator who'd be willing to take your $1 million as part of their $3 million raise. But now, you have to qualify for the debt a lot of times. That means you get an equal vote in it, you as the tick owner. And if somebody, if that operator has a lot of experience and all of a sudden you can have an equal vote with them, that might be pretty uncomfortable for that operator with 20 years experience to have somebody who doesn't know anything about, let's say, an apartment building operation being able to completely, overrule them effectively by being a rogue investor.
Right.
Somebody told me the other day they had 5 ticks going together, all 5. And I said, well, I hope you 5 are good friends and you're unanimous on all your votes. Right, Warren?
As I say, yeah, you I will still see them like where it is a group of friends, a couple of people, 3 people,
Right.
whatever. And that's but if we're talking on a large scale, you're talking 40 investors, 50 investors or more. That it it's not good for the investor and it's not good for the operator.
Right.
Right.
Just want to remind everyone, if you do have a question you want us to answer the next 12 minutes, if you want specifically Warren, who is a CPA, a tax strategist, someone who's been doing this stuff a very long time, put it in the question box. Even if it's not right on this topic, I would encourage you to try to get as much value out of this as you can.
Sure.
Someone asked, if I pursue a DST route to offset capital gains on primary residence sale, how does the timing work during a year of sale? Better to sell earlier in the year to allow more time to identify DST options?
Yeah, well, I mean, like I said, the most important thing is first, and it's a tight wire walk a little bit, right? You have to rent the property out long enough that you get and Paul will know what I'm talking about when I say that you can get your 1031 exchange person to sign off that it's really a rental property and you weren't and this wasn't just a ploy to avoid taxes, right? So it has to have that realism. But you also have the look back period where it has to be your personal residence for a long enough period of time too. So it's really a tightrope, and you have to be able to close on the property on the time. So if you are going to do anything like this, I would definitely say you want to do you want to go into a DST as opposed to finding your own property, because all kinds of things can go wrong in the closing and throw off your timing there. And it has to be so precise for this that the DST, basically, you tell me if I'm wrong about this. This is the way I always thought of them. You're the DST guys. So those DSTs, they're ready to take your money pretty much whenever you're ready to give it to them. So it makes the timing work so well.
Right.
Mm-hmm.
Yeah, that's good.
He said I think this was answered, any impact on the amount of tax shielding if reinvesting the funds later in the year within the same year?
So it's not even when we're looking at at using the exclusion for your home. We get the $500,000 exclusion, but it's to the day, right? It's not a calendar year that we're looking at. It's to the day that you sell it, right? We have a 5-year look back period. So that look back period is it's to the day. So so it doesn't, later in the year might be 1 day too late.
Okay.
Mm.
Can I perform a partial 1031 into a DST?
Sure, you're just going to pay
Mhm.
tax on the amount that doesn't go in. So whatever you don't do a 1031 exchange on is called boot. I just wanted to say that because I think it's a cool word. It makes me think of like booty, we're going to rob the bank. But so that's
Right.
boot that you're going to get, and you will pay whatever the capital gains is on that boot.
Right. Right. So that's one of the advantages of the 1031 exchange is you're not only getting a passive asset managed by a professional operator, but you're also getting to put in as little or as much as you want to, as long as it meets the minimum investment requirements. For our DST, it's an accredited investor, $100,000 or more. And that is covering, we're adding debt to that. And so it's actually giving you a higher stake in the property. We're not here to talk about 1031s and the DST details, but if you want to learn more, you can learn more. Ben, should I pull that slide up with our contact info and then we can add Warren's verbally?
Yeah, if I think it's wellingscapital.com/resources, and I don't think that link is on there, but there's an ebook on DSTs and 1031s. If you go wellingscapital.com/resources, you can get a free ebook on that. And then Warren, what's the best way for people to reach you?
Best way to reach me is via our email address, and it's info at tacpas.com. So TACPAS. It's basically Tarl Accounting CPAs.com.
Perfect. Okay, more questions. I have multiple San Francisco properties I'm selling
Single family.
in order to. Okay, multiple single family properties I'm selling. Nice catch. To capture and reinvest my appreciation. They will not sell all at the same time. Can I set up a DST myself and as I sell, move the money into it?
Huh.
It'll be tough. I mean, to setting up so here's the thing, you don't need to set up your own DST. So again, so Paul in Paul's DST, right, he said it's $100,000 minimum investment. So basically, and I don't know how you work it, but if you got, as these things sell, again, the nice thing with the DST is they'll take your money whenever you're ready to give it to them. So we don't have to do all the closing and all the worries we have to do with if you're buying new individual properties. You can, if it's $100,000 profit or $100,000 you're getting out of each one or more, I'm sure you can make those payments into the DST as you sell them and preserve the 1031 exchange. I don't know, do you guys take would you take 50 over a period of a few months, or?
Yeah, It'd be tough because the DST are only open for a certain amount of time,
Right.
and it'd be hard to guarantee the timing of that. But I mean, if to the person who asked this question, if setting up a DST is quite expensive and difficult. We just went through the process
We're not
of
just
doing
saying
that.
that.
Yeah, I mean,
Yeah.
you're looking at $50,000 to $60,000 of legal fees alone just to get the documents drafted. So it's usually not worth it just to do it. If it sounds like maybe you're not willing to relinquish control of the deal, maybe that's why you're asking it. And in that case, there's probably some other routes for you. A lot of people are very happy to give up control of the deal for the sake of being a passive investor.
Right.
If I sell an asset for 1 million and I have a $500,000 capital gain, can I put 500K into the DST and defer all the gain? Or do I have to put all 1 million into the DST to avail the gain tax?
So yeah, if you want to
Mm.
eliminate all of the tax, you have to put the whole $1 million in.
If you're
Okay.
doing a 1031 exchange, you're right.
Right. If we're doing this other thing we've been talking about earlier,
Yeah.
we'd have to do the math.
Yeah.
You
It'd be
could
math.
probably get away with that.
Yeah, you might be able to, right? That's one of the great things about why I'm so excited about this strategy. It would just be coming down to math. And so, what else we have, Ben?
Yeah, can we cover how depreciation recapture is calculated for a property sale? Is it just the sum of the total depreciation taken on the property between purchase and sale?
Exactly. Subject to the amount of gain.
Right.
So let's say let's keep this super simple. And let's say you bought a property for $100,000 and you had $25,000 of depreciation on that property, and we sold it now for 125,000. So you're looking at it and say, well, I had a capital gain of $25,000 because I sold it for $25,000 more than I paid for it. Okay, but then I also had the $25,000 of of depreciation. So the part that was depreciation gain, you pay at the higher recapture rate, and the part that is pure gain from it just going up in value, you get the capital gains rate at. But it could go the other way around. If you sold the property now for $90,000, so you actually have a loss, but you still have that recapture, all of it would be recapture. That makes sense?
Yeah, yeah. Let us know if that makes sense. Um, someone asked, what's Warren's email, contact, or website one more time?
The website is tacpas.com. So tarleaccountingcpas.com, tacpas.com. And the email is just add an info at to the front of that. So info at tacpas.com.
Mm-hmm. Info at TACPAS.
TACPAS, yeah. It actually sounds cooler than it to say it TACPAS.
Yeah. All right. Well, Ben, I think we've hit our hour here almost. So we're
Yeah,
really
I,
grateful for everybody who joined us. And I'm really grateful to you, Warren, and to you, Ben, for joining us as well today.
yeah, Warren, really appreciate it. And I think if your head is spinning after all of this, which probably is, there's so many nuances to all this. If you think, like we talked about earlier, if you think you might be eligible for something like this, if you have a gain in 2020 that you're looking to defer, reach out to someone, reach out to a CPA, reach out to Warren. He's a real estate expert. He knows it, he lives it, and has done so for a long time. Get some advice. Talk to as many people as you can. Don't make any super hasty decisions. But at this point in November, you're going to have to move pretty quick. So you're going to put some time into this. But yeah, we really hope that this strategy and what we just talked about can save you guys hundreds of thousands, millions in taxes. So.
Right. All right. Well, thank you very much. The recording for this will be coming out. You'll get it automatically if you signed up. And again, we thank you. We hope you have a wonderful, peaceful weekend, and we'll see you next time. Thanks.
Thanks, you guys.